Operational Risk Interview Preparation Guide for Risk Teams. If you are preparing for operational risk roles in banks, investment banks, or large financial institutions, this video is built exactly for you. We have created very comprehensive interview preparation material, specially designed for operational risk teams, not generic definitions or compliance checklists. In this session, we go deep into how operational risk works in practice. From process failures and control breakdowns to RCSA, KRIs, loss events, scenario analysis, business continuity, system outages, and regulatory expectations. You will learn how interviewers expect you to explain risk frameworks, incident response, root cause analysis, governance, and independent challenge. Clearly, calmly, and with structure. Do watch this video till the end. This level of preparation genuinely differentiates strong operational risk candidates from average ones. Explain the primary responsibilities of an operational risk analyst in a financial institution. Operational risk analysts protect the firm from losses caused by failed processes, human mistakes, system breakdowns, or external events. Your core responsibilities include identifying risks in day-to-day processes, assessing control strength, monitoring incidents and near misses, and escalating issues early. You review key risk indicators, challenge first-line assumptions, and support risk assessments across business units. You also coordinate loss reporting, scenario analysis, and regulatory submissions. Your job ensures the firm runs safely, not just profitably. Describe the difference between operational risk, market risk, and credit risk. Operational risk arises from process failure, human error, fraud, system outages, or external disruptions. It is not driven by markets or borrowers. It is driven by internal controls. Market risk comes from price movements, equities, rates, FX, or commodities. Credit risk comes from borrower default or counterparty failure. Operational risk is unique because it exists in every business activity, even if no trading or lending occurs. Walk me through the components of an operational risk management framework. A complete framework includes risk identification, mapping processes and finding weak points. Risk assessment, scoring inherent and residual risks. Controls and testing, validating that controls work. Loss data collection, capturing incidents, breaches, and near misses. Key risk indicators, metrics that warn early. Scenario analysis, modeling severe but plausible events. Issue management, tracking remediation plans. Governance, committees and reporting flows. This framework keeps risk management consistent and repeatable. End. Explain the 3 lines of defense model and how each line contributes to operational risk management. The first line is the business. They own the risk, operate controls, and manage daily processes. The second line, operational risk, provides oversight. We challenge controls, review assessments, and monitor trends. The third line, internal audit, independently tests and validates both the first line and second line. Together, the 3 lines ensure accountability and prevent blind spots. A significant process failure occurs in trade settlement. What steps do you take to investigate and report it? Start with containment. Ensure no further trades fail. Communicate to operations and risk teams immediately. Next, gather facts. What step failed? Was it human error, system issues, or data quality? Then assess impact, financial losses, regulatory breaches, client impact, reputational harm. Document the incident clearly, classify the loss, and escalate according to severity thresholds. Finally, begin root cause analysis and define corrective actions. Describe how risk and control self-assessments, RCSA, are performed and validated. RCSA begins in the first line. They list processes, identify risks, map controls, and score likelihood and impact. Operational risk, the second line, reviews these assessments. We challenge ratings, test controls, and confirm evidence. We ensure risks are not understated and controls are not overestimated. Valid RCSA results give a realistic view of where the firm is strong and where it is exposed. Explain key risk indicators, KRIs, how they are designed, monitored, and escalated. A key risk indicator is an early warning metric. Examples include trade breaks, system downtime, failed reconciliations, staff turnover, or call center complaints. To design a KRI, you choose a measurable event that signals rising risk. Set thresholds, green, amber, red, based on risk appetite. You monitor KRIs regularly and escalate breaches with clear commentary. KRIs allow teams to act before incidents occur. Provide examples of operational losses and how they should be classified and reported. Operational losses include fraud, processing errors, system outages, vendor failures, legal or compliance breaches, unauthorized trading, cybersecurity incidents. Losses must be classified by event type and business line. They must be documented with cause, impact, and remediation plans. Accurate classification helps spot patterns and supports regulatory reporting. A control breaks repeatedly. How do you assess root cause and drive remediation? First, confirm that the control truly failed. Gather logs, data, and examples. Next, perform a root cause analysis. Ask, is the control poorly designed? Is it executed incorrectly? Is there a skills or training gap? Is the system unreliable? Then design corrective actions. Redesign the control, add automation, or update procedures. Finally, track remediation to completion and retest effectiveness. How do you evaluate the effectiveness of internal controls for high-risk processes? Start by reviewing control design. Does it prevent, detect, or correct risk effectively? Next, test the control. Observe execution, sample transactions, review documentation, and look for exceptions. Assess timeliness, accuracy, completeness, and segregation of duties. High-risk areas require strong, consistent, and well-evidenced controls. Describe how scenario analysis is used to measure operational risk. Scenario analysis explores severe, low-frequency events that historical data cannot capture. You work with business experts to imagine realistic extreme events: a major cyber attack, a rogue trading incident, a large settlement failure, or a data center outage. You estimate financial losses under each scenario: direct losses, recovery costs, legal fees, reputational impacts. Scenario results support capital calculation and highlight weak points in the control environment. Explain the role of operational risk in new product approvals, NPA. Operational risk ensures new products can be executed safely. We review the entire workflow: booking, confirmation, settlement, valuation, reporting, and controls. We identify gaps, missing systems, unclear responsibilities, incomplete testing. We also assess vendor dependencies, legal documentation, and regulatory requirements. Approval is granted only when operational processes are robust and well-controlled. How do you perform process mapping and identify control gaps? Start by listing each step in the process: inputs, systems, users, outputs. Draw a simple flow diagram. Highlight where decisions occur, where data flows, and where handoffs happen. Then, identify risks at each step: incorrect data, manual overrides, system errors. Next, review existing controls, Are they preventive or detective? Are they working? Finally, document the gaps and recommend stronger or automated controls. A fraud incident is detected. What immediate actions and long-term responses do you initiate? Immediate actions: secure systems, freeze access, alert compliance and legal, preserve evidence. Next, quantify the loss and assess whether the fraud involves external actors or internal staff. Long-term actions include root cause analysis, strengthening access controls, updating approvals, adding monitoring tools, and reinforcing staff training. Fraud incidents require fast, coordinated response. Describe how you assess vendor and third-party risk. You begin by identifying critical vendors: IT providers, custodians, payment processors, data suppliers. Assess their financial stability, cybersecurity posture, service level commitments, and operational controls. Review audit reports, penetration test results, and incident history. Finally, monitor ongoing performance. Outages, delays, or quality issues often signal deeper problems. Vendor failures can become your failures. So, oversight must be continuous. Explain the purpose and methodology of Business Impact Analysis, BIA. Business Impact Analysis identifies which business functions are critical and how quickly they must recover after disruption. You estimate financial impact, regulatory impact, and client impact of downtime. Methodology includes interviews with teams, mapping dependencies, assessing technology, people, and locations, and determining recovery time objectives. BIA informs business continuity and disaster recovery planning. Walk me through how business continuity planning, BCP, and disaster recovery, DR, are tested and validated. Business continuity planning ensures critical business functions continue even during disruption. Disaster recovery focuses on restoring technology and systems. Testing involves tabletop simulations, system failovers, alternate site activation, and communication drills. You validate by evaluating performance. Did teams follow the plan? Were recovery times met? Were backup systems accurate? Lessons learned feed into plan updates. You observe recurring near-miss events. How do you analyze and escalate them? Near misses reveal weak controls before losses occur. Start by categorizing events: system errors, manual mistakes, delayed approvals. Look for patterns. Are they concentrated in one process or team? Escalate if frequency increases or severity rises. Recommend control enhancements, additional training, or system fixes. Near misses are free lessons, but only if acted upon. Describe how operational risk interacts with cybersecurity and data privacy risk. Cyber and data risks are part of operational risk because they arise from system vulnerabilities and human behavior. Cyber incidents can cause data loss, downtime, regulatory violations, and reputational damage. Operational risk evaluates access controls, detection tools, data handling practices, and response plans. Data privacy failures, like mishandling customer information, can lead to heavy fines, so controls must be strong. Explain how issue tracking, remediation plans, and risk acceptance processes work. When a control gap is identified, it becomes an issue. Each issue needs an owner, a due date, and clear remediation steps. Operational risk monitors progress, sends reminders, and escalates overdue items. If a risk cannot be fixed immediately, or at all, the business may request risk acceptance. This must be justified, documented, and approved by senior management. Issue tracking ensures risks are not forgotten or ignored. A major system outage disrupts front-to-back processes. How do you evaluate the operational risk impact? Start with impact assessment. Which systems failed? Trading? Settlements? Risk reporting? Identify which processes stopped and how long the outage lasted. Next, determine financial impact. Missed trades, delayed settlements, or incorrect reporting. Then evaluate regulatory impact. Were reporting deadlines missed? Did clients experience delays? Review root cause and needed controls, improved monitoring, failover systems, or revised runbooks. System outages test operational resilience. Your role is to quantify impact and prevent recurrence. How do you validate assertions made by the first line regarding control effectiveness? Begin by requesting evidence, screenshots, logs, reconciliations, or workflow reports. Observe the control in action if possible. This reveals whether the process is followed consistently. Next, perform sample testing. Pick random transactions and verify that the control operated as described. Challenge overly optimistic claims, especially when evidence is weak or incomplete. Validation requires independence, curiosity, and professional skepticism. Describe the process of performing deep dive reviews for high-risk areas. A deep dive focuses on areas with repeated incidents, high volumes, or critical importance. Steps include mapping the end-to-end process, identifying failure points, reviewing historical incidents, testing key controls, and interviewing staff. You also benchmark practices against internal policies and industry standards. Finally, document gaps, propose improvements, and prepare a clear report for management. Deep dives reveal underlying weaknesses that routine reviews may miss. How do you assess operational risk during system migrations or large transformation projects? Start with project governance. Ensure roles, timelines, and responsibilities are clear. Review design documents to understand changes to processes, data flows, and controls. Assess technology risk, data conversion integrity, access changes, integration points, and rollback plans. Verify user acceptance testing. Did testing cover high-risk scenarios? Finally, require contingency plans and post-migration validation. Large projects often create hidden risks. Your role is to surface them early. Explain the role of operational risk in regulatory submissions and audits. Operational risk ensures submissions are accurate, complete, and timely. We review data controls, validate assumptions, and confirm evidence supports reported figures. During audits, we provide documentation, explain RCSA results, and walk auditors through incident management, controls, and remediation progress. Regulators view operational risk as a key indicator of governance strength. A new regulation introduces strict operational requirements. How do you ensure compliance? Start by interpreting the regulation. Identify obligations, timelines, and penalties. Next, perform a gap analysis. Compare current processes with new requirements. Work with business, compliance, and technology to design new controls or enhance existing ones. Develop training materials and ensure staff understand expectations. Finally, track progress until full compliance is achieved. Regulatory change must be proactive, not reactive. Describe the role of governance committees in monitoring operational risk. Governance committees oversee risk exposure at a senior level. They review incident trends, key risk indicators, high-risk issues, audit findings, RCSA results, scenario analysis outcomes. Committees provide challenge, demand accountability, and approve risk acceptances or escalations. Good governance drives a strong control culture. How do you quantify operational risk exposures, and what models are typically used? Banks use models to estimate potential losses from operational events. Two main approaches exist. Loss distribution approach. statistical modeling of historical loss data, scenario-based capital modeling, combining expert judgment with stress scenarios. Some institutions also use hybrid models, blending historical data with forward-looking risks. Quantification supports capital adequacy and risk appetite decisions. Provide an example of measuring conduct risk and how it fits into the operational risk framework. Conduct risk involves behaviors that harm clients, markets, or the firm. Example: a sales team misrepresents product features to clients. Even if no loss occurs immediately, this is a conduct risk issue. Measurement includes customer complaints, trades canceled for errors, compliance breaches, and tone of culture surveys. Conduct risk fits within operational risk because it arises from people, processes, and culture. How do you evaluate segregation of duties, SOD conflicts, and their associated risks? Segregation of duties ensures no single person can execute and approve high-risk activities. You review system access, workflow approvals, and user roles. Then identify conflicts. For example, the same person can create a vendor and approve payments, or a trader can book and confirm trades. Each conflict is scored by risk level and requires remediation, access removal, workflow redesign, or increased monitoring. SOD protects against fraud and errors. A key person leaves unexpectedly. How do you assess the operational risk impact? First, identify what processes the person supported: approvals, reconciliations, system knowledge. Check whether backups exist. If no backup exists, assign temporary support immediately. Assess process fragility. Could deadlines be missed? Could errors increase? Escalate risks to management and initiate knowledge transfer plans. Key person dependency is a major operational risk that must be monitored proactively. Describe how internal audit findings feed into operational risk assessments. Internal audit evaluates effectiveness of controls independently. Their findings reveal weaknesses, failures, or emerging risks. Operational risk reviews these findings and updates risk ratings, control assessments, and RCSA results accordingly. Unresolved audit findings trigger issues and remediation plans. Audit results strengthen the overall risk framework. Explain how operational risk reporting is designed for senior management. Reports must be clear, concise, and focused on key exposures. You summarize incident trends, major losses, high-risk issues, KRI breaches, top scenarios, remediation progress. Use simple visuals, heat maps, traffic lights, trend lines. Senior management wants insight, not noise. Your task is to highlight what truly matters. A large operational loss occurs. How do you document, classify, and communicate it? Start with immediate notification to senior management and relevant control teams. Document facts: what happened, when, why, who was affected, and financial impact. Classify the loss using the operational risk taxonomy: execution error, external fraud, system failure, and so on. Prepare a clear incident report outlining impact, root cause, and remediation. Maintain transparent, timely, and accurate communication. How do you challenge first-line assumptions when assessing control weaknesses? Ask probing questions. Has this control been tested recently? Where is the evidence? Are exceptions monitored? Does automation reduce human error? Compare their statements with incident history and KRI trends. If assumptions seem optimistic, recommend independent testing or a control redesign. Challenge should be respectful but firm. Independence is essential. Explain the difference between inherent risk and residual risk. Inherent risk is the level of risk before controls are applied. It reflects natural exposure based on process complexity, volume, and environment. Residual risk is the level of risk after controls are applied. It depends on control design and control effectiveness. Residual risk guides remediation priorities and management decisions. Describe how emerging risks, AI, cyber, cloud, outsourcing, are identified and monitored. Emerging risks arise from evolving technology and business practices. Operational risk identifies these by monitoring industry trends, reviewing incidents from peers, evaluating new technologies, and performing impact assessments. Cyber risk grows as data moves to cloud environments. AI introduces model risk and bias concerns. Outsourcing increases dependency on external vendors. These risks require regular reassessment as environments change. Explain how cultural and behavioral factors contribute to operational risk. Weak culture increases the likelihood of failures. Examples include pressure to meet targets leading to shortcuts, reluctance to escalate issues, poor training, lack of accountability, or tolerance of risky behavior. Operational risk analyzes culture through surveys, incident patterns, conduct metrics, and staff turnover. Culture is the foundation of effective risk management, or the root of recurring failures. Describe a scenario where you identified a major operational risk and how you mitigated it. Here is a simple, clear example. You notice repeated delays in trade confirmations for a high-volume desk. KRI trends show rising backlogs. Analysis reveals understaffing and outdated systems. You escalate immediately and recommend temporary staffing, automated confirmation tools, and a review of batch processing schedules. Within weeks, backlogs fall and error rates improve. Proactive escalation prevented regulatory breaches and settlement failures. How do you build effective relationships with business teams while maintaining independent oversight as an operational risk function? Start with collaboration and clarity. Listen to business needs, understand their pressures, and speak their language. Be transparent about your role. You are a partner in safe operations, not a blocker. Provide practical recommendations, not just criticism. Offer training, risk insights, and help strengthen processes. At the same time, maintain independence, escalate when needed, and stick to evidence-based assessments. Respect and objectivity together build strong relationships. Operational risk is not about preventing every failure. It is about preventing small failures from becoming big ones. This was a complete end-to-end interview preparation guide created specifically for operational risk roles within risk and governance teams. If you followed this entire session, you now understand how operational risks are identified, how controls are challenged, how incidents are managed, and how resilience is built across the organization. Practice explaining them clearly, because judgment, structure, and independence are exactly what operational risk interviewers assess. For more deep, role-specific preparation across operational risk, market risk, credit risk, and banking governance careers, stay connected. And once again, do watch, revise, and master this material.